Julian Emanuel of Evercore ISI. Julian sees the potential for a volatile April. He's the firm's senior managing director. Julian, great to have you. Whatever you roll, you don't think there's any possibility that the Fed's going to hike?
No.
Is that what you're
No, it's not an eye roll over what Dan said.
Just Dan in general?
No, it's okay. Are you kidding? He looks fabulous.
I know, he does.
It's the consequence of even the market thinking there's a possibility of that. And look, I think part of the narrative that's going on now is there's a tendency to say, well, something worked this way, so it's going to work this way again. And look, frankly, the move from 6 expected cuts to 3 was something that we did not expect the market to take as well as it has taken it. But again, like this whole idea of 3% inflation back towards the 2% goal, this last mile is a little bit more difficult. And so, therefore, this idea of 3 cuts maybe going to 2, we don't think the market's going to digest that as easily as it digested the kind of move from 6 to 3, because you're 10% higher. You're on 21 times earnings and expected growth of north of 11% for 2024, which is high by no landing scenarios. So we do think there's some volatility ahead.
How does the inflationary sort of readings that we've had when it comes to various commodity prices, services being stickier, et cetera, how does that factor into your view of what the Fed might or might not do?
Well, it made Easter a very expensive holiday this week, given that cocoa's over $10,000 a ton. The Fed has hinted that it's going to give us something that it has literally never given us. OK, you've had really one cycle where there was cutting into a soft landing, being 1995. And the fact is that happened when core PCE was already close to 2%. So it's really kind of one of those, a belief that you're going to get that last mile. And we can already look ahead in a week and a half from now. It makes the CPI data unbelievably important because the narrative is now at the point where, particularly given that momentum stocks have stalled out in the month of March, that's the kind of thing that's a threat to the broader market.
So let me ask something. If CPI continues to run a little hotter now than we had hoped, and the Fed does nothing, aren't they, in fact, decreasing real rates?
So there's the conundrum, right? You walk this fine line between movements in real rates. And again, we have to understand that based on the last 7 or 8 years, real rates are high. But based on the last 20, they aren't necessarily that high. And remember, I think part of the shock of the last number of months is like, wow, we can actually make money in stocks with interest rates north of 5%. It happened throughout the 1990s. I would suggest is sort of the opposite thing is the problem, is that if the Fed keeps indicating that it looks like 2 or 3 cuts, you get the 10-year yield moving sharply higher to discount a longer trajectory of inflation. And that's what bothers stocks more than whether it's 3 cuts or 2 cuts.
Julian, your target for the S&P, I think, is 4750 this year. What gets us there?
Look, the environment that we're in now, we've seen a lot of what I would call head-scratching activity on the part of the investing public. FOMO, irrational exuberance, call it whatever you want. But when you're making bets in the options market that the price of a $2 trillion market cap stock is going to double over the next 4 days, there's something going on there. And so from our point of view, what you really, this is a time where, again, this is not an end of the bear market, the bull market call, pardon me, that was no pun intended, it's a normal correction of a market that likely goes higher but needs some time to catch up. And that's only going to be a function of if you get disappointing data, because we really are priced for great earnings, great interest rate trajectory, and inflation not being as sticky as it's proven the last couple months.